panic has hit Indian markets hard and
Nifty trading has been
BSE
halted.
और सेंसेक्स में भारी गिरावट दर्ज की गई है.
I think the first time I find that the market was caught wanting in terms of regulatory steps coming in to add to the margins in the last 3 to 4 days.
8,555 and right now the market says 9,592, which means a full 1,000-point recovery is what you have seen.
So 1539 points up on the Sensex, 34,295. The broader end of the market too has shown you a lot of gusto. Ladies and gentlemen, you've heard of Freaky Friday. This is perhaps the freakiest Friday that we've ever seen on Dalal Street. Good evening. Hello and welcome to the India Development Debate. I'm Nayantara. What a day it's turned out to be. This was one roller coaster ride. You had the Indian markets hitting the lower circuit. Trading was halted for 45 minutes and then you had the best ever recovery on Dalal Street. Like I said, it's Friday the 13th. But it started off like that, but it ended on a fantastic note. If you're a bull, if you still have conviction in the India story, if you still believe that the fundamentals are strong, the closing was certainly something really sensational to talk about. In my 15 years of journalism, I've never seen a day like this on the stock markets. And let's get you an editor's take now with Nikunj Dalmia. He understands the markets like no one else. Here he is with the editor's take.
20 years I've been tracking and commenting on markets. I've never seen this kind of a day. When hope and despair, they both have coexisted. First half scary, second half great. If you were on the right side of the trade in the first half of trade in the first half, then you were on the wrong side of the trade in the second half. Completely vice versa. Markets typically react like this when there is pandemonium on the street, when there is confusion on the street, and when the system freezes with panic. And I think the system in the morning froze with panic. A lot depends on the medical news. China is claiming that things are looking up. Italy is indicating that things can get back to worse. So you really don't know which way the medical news is going to move. And the medical news, in a sense, is going to be the circuit breaker. The green light is going to be when medical news changes. There's so much of liquidity in the system that whenever markets will recover, like they recover today, recovery is going to be very, very sharp. So that's one variable factor, which is the big unknown. The way I look at things, Aisha, moving is that markets today, stock prices have reacted and adjusted to the panic. I guess news now will start coming out from various companies, sectors, individual, CEOs who would now document the impact of coronavirus. That, I think, will be an individual stock market reaction. For me, in my book, based on price action, my experience, what I've spoken on the record conversation, off the record conversation with some market gurus, is that when you see this kind of a price action, it normally changes the trend. The trend has been weak. I'm not saying the trend is going to reverse, but hopefully we could be in for a V or a U-shaped kind of information. I think by and large, markets are debating two things now. That's my sense. One, there will be a dramatic drop in earnings. Will that lead to a recession? I don't think that is in the price. If liquidity and if things improve on the medical front, there's no recession around the corner, then maybe locally and globally, markets will try and establish a bottom. But I think we're going to fasten a seal bet for a lot of volatility because news has not stabilized. Till the time news does not stabilize, I don't think markets also will stabilize. So today was an interesting and historical day. I hope we are not in for such crazy days ahead. But when you see a day like this, you could ask yourself one simple thing, that ultimately when you keep calm, when you see a panic like this, if you are a buyer, I think you will always be rewarded.
Our managing editor, Nikunj Dalmia, he of course understands markets better than anyone else out there, tracking the stock markets for 20 years. Like I said, a freaky Friday. Something else to talk about, Wall Street. What a rebound on Wall Street. The worst day for Wall Street in 30 years, since 1987. But you look at Wall Street today, look at what's happening at the Dow, the S&P 500, NASDAQ, a remarkable recovery at Wall Street as well. Let's talk about what's going on. Of course, coronavirus is the biggest culprit that you've got there. Joining me to talk about equity markets around the world, global growth, global economy, asset classes, Punita Kumar Sinha, managing partner at Pacific Paradigm Advisors. Incidentally, she is joining us from Boston. We're also being joined by Hugh Albert Johnson, Chairman and Chief Investment Officer at Hugh Johnson Advisors. And later on the show, we're also going to be joined by Jim ONeill, the former chief economist at Goldman Sachs, and of course, he was a former Commerce Secretary for the United Kingdom. Hugh Albert Johnson, I'm going to come to you first. How are folks like you navigating through what's going on? You are the worst day on Wall Street since 1987. Look at the rebound today. Our own markets, Freaky Friday. Trading is halted for 45 minutes. Then you have the best ever recovery for the Wall Street. I don't know what you're eating or drinking to keep up with the insanity out there, but what's going on?
Well, of course, the volatility is unprecedented, and that's if you look at the last 20 years. But I think what you just said was pretty important. You said, let's go back to 1987. And if you go back to 1987 and you see that 22% decline in one day in the Dow Jones Industrial Average, that was pretty scary then. But I also remind everybody that, in time you recover. By the end of the year, after that October collapse, the market was 24% higher than at the bottom of that collapse in October. So I know everybody's worried. I know everybody's caught up, or a lot of folks are caught up in the day-to-day volatility. But I'm saying step back from that. Pay attention to what's happened in history. And if you pay attention to what's happened in history, you won't be as caught up in the day-to-day swings or volatility. And you'll recognize that this will end and the market will move higher in time. But it might take a little bit of time. So patience and an understanding of what's happened in history is vital to keeping your wits about you during this extraordinarily emotional period.
Puneet, if I could come to you now, it's literally to hell and back, the Wall Street and what you're seeing on Wall Street today. You are in Boston. When you speak to your clients, what's the best advice you can give them? Because if panic is the word on the street and cash is king, everyone's pulling out. And they're getting out of foreign markets as well, right? So what is it that you tell your clients? What's the kind of feedback you're getting from your clients?
There is, I have to say that I was in India earlier this week and I'm in Boston now. And the mood in the US is far more negative on the coronavirus than there is in India. While in India, of course, economic growth has been already trending down and has, of course, the last bit of data was a bit positive, but in the sense the mood on in the corporate sector was already negative. The mood in the US has now turned very, very negative. And companies are really gearing up for a fairly bad recession, and therefore everybody's building their cash reserves and tapping into credit lines. That's one thing we are seeing. Now, in terms of the markets itself, I think in so much volatility, it's very hard to really go aggressive in any one direction, whether you're selling or buying. So you have to stay put generally. But, we had raised some cash in the last 1 month, but I would say that some amount of cash is good to have so that if markets do decline further and you get better entry points, you can deploy the cash. But of course, I think a large part of the selling has already happened. So only if markets rebound due to some Fed announcements or other global coordinated efforts that one could potentially raise some cash. At that point, if there's a strong recovery, hoping that you would get better entry points once again, given that this news on the coronavirus is not over yet.
The news on coronavirus is not over, but at least, if you go by the data that's coming out, the countries that saw the outbreak first, beginning with China, it has peaked out. China's factories are showing signs of coming back to life. So Hugh Albert Johnson, my question to you is, and I'm picking up from where Punita left off, do you believe that the worst is behind us? Or is that something that we actually want to believe? Yes, the worst is behind us. We've had the worst fall since 1987. Heck, how much worse can it get?
Well, it could get worse, but let me just say what you said was pretty important, and that is the evidence is that China's coming out of it. They're starting to get back on their feet. There's what's we call containment. We don't see that. The U.S. has been very, very behind the 8 ball, has not responded well to the outbreak of the virus. my expectation or hope, let's put it, my fingers are crossed, that we'll start to see better behavior or performance by the healthcare officials in the U.S. and we'll get some sort of a containment. But that's not coming until the end of, let's say, the spring and the early part of the summer. And that's something you have to cross your fingers and hope for, that we'll start to see us, the U.S., start to rebound the way China is rebounding. The biggest worry everybody should fear is that we have a resurgence of the virus. If we do get containment in the early summer, that we get a resurgence in the fall or a repeat of what we're seeing right now. That's what you have to worry about more than anything. But right now, remember, behind every dark cloud, there's a silver lining. We've got a very sharp decline in prices in the U.S. equity markets. We've gone from being overvalued to being meaningfully undervalued, and that's very good, even though I don't think we've reached an emotional extreme. Yes, there's increased pessimism, as your other guest has said, but it has not been as significant enough or low enough or as much pessimism as we want to see to say we've reached an emotional extreme. So good news, we're undervalued. Not such good news is that we probably have to go to a little bit of a lower level to establish that emotional extreme and that low. But nevertheless, we're no longer overvalued, and that's good news.
We're not overvalued. There perhaps is going to be some more downside pressure. You're going to see whether it's the emotions that are coming in. But then, Punita, what's going to happen to emerging markets? You know, emerging markets haven't been given the kind of returns that, you know, investors had hoped for. Is there a fear that, you know, India could fall out of favor? Or is this now more than ever where India stands to gain? Because out of all the emerging markets, look at the returns it's getting the investors so far.
I've always maintained that the U.S. valuations were quite high relative to emerging markets, and emerging markets looked attractive on valuations. Value obviously hasn't been working in the last several months, but I think if India is able to arrest its economic slowdown, and so far, I mean, from what I've seen, that the coronavirus situation hasn't impacted India as badly as it has impacted some other countries. And if we are able to manage that, then I think people will be more confident investing in India. US was always at more risk, and therefore I think the valuations and the growth story here isn't in the US isn't looking as good as it was, say, a year ago. India, the growth story is already kind of discounted in the valuations. So I would say relatively India looks better than the US.
You have any thoughts on that? Do you think that is indeed the case, that this could be India's moment? You know, we perhaps are going to see investors being wary of China. I think one of the big lessons has been that you shouldn't be too hedged to a country, whether it's your equities or it's your manufacturing capabilities.
Yeah, we have underweighted international stocks versus U.S. stocks for a long, long time. I think we've been right on that so far. Quite frankly, I think when you look at all of the individual emerging market companies or stock markets, I think that their valuations look much more attractive than they did, and that's really good news. And they'll probably recover or do better than the U.S. now for the foreseeable future. But I don't mean a long-term future, somewhat of a future. They've gotten a head start on the recovery from the coronavirus, in my judgment. In time, the U.S. will start to get its act together. In time, the U.S. markets and economy will recover. It's a little bit too soon to say that right now. So emerging looks good for now. In time, the U.S. will be fine and it will catch up. But from a timing point of view, it's probably better in emerging right now, even though we've underweighted it for a long time and we've been right about that. Now I'm starting to look at emerging as being attractive from a valuation point of view and a timing point of view.
You know, I've got to say one thing. Talking to the two of you, I'm certainly feeling a lot more optimistic than I did at 8:59 p.m. going into the prime time 9 o'clock show. None of you are talking about gloom and doom. None of you have used the word recession, the threats to global growth, and all of that. Hugh, so you really believe that going forward, we're going to see a recovery. We're not in a recession. We're not entering a bear market.
Right. Let's just say this. You're talking about the end of this cycle. We're talking about a bear market that started in the middle of February. We're headed towards a recession in the U.S. I would put that as the second and third quarter that will have a contraction or negative growth in real GDP for the U.S. From a timing point of view, that means somewhere in the middle of that recession, second, third quarter, probably third or fourth quarter, we'll start to see a bottom in the U.S. stock market and a recovery in the U.S. stock market. So yes, I'd use the word recession, even though we're revising our forecast for 2020 down to 0.6%. And that's all. That's a positive number. That's a number for the year. You'll still get a couple of quarters of contraction during that 0.6% growth for the year. But when we look at 2021, it looks a lot brighter. But I'm not taking the word recession or contraction off the table at all. I'm saying that's going to be a part of 2020 and also a stock market bottom within the context of when that recession unfolds.
Okay, so Punita, if I could now come to you, and this will be my final question for the discussion. If a recession stays on the table, the bear market phrase stays on the table, and the question then is, how bad is it going to be? We were just recovering from 2008. We were seeing, America, pardon me for using this pun, becoming great again. We were seeing the recovery. There were all these talks about flight of capital and all of that. And then you have the coronavirus. Now you've got the global growth story, which you don't know what's going to happen. Look what Christine Lagarde has had to say. Geeta Gopinath have been saying. If that still stays on the table, the question then is, how bad? And if you don't know how bad, I again come back to my starting question. How are you getting people to part with their money? They perhaps want to sit on their cash. They want to know how bad it's going to be.
No, you're right. I think actually things can get quite bad. Just looking at the economic activity and how every company is in the US forcing employees to work from home. There is a lot of travel ban. So business activity is definitely slowed down and will slow down, and there will be a recession if we are not in one already. So I think the recession is definitely there. Now, whether the equity markets kind of move in a different direction depends a little bit on what the Fed does, how much monetary stimulus is provided, what happens on the fiscal side. So the markets might still recover, although I don't see them going past their last highs. I don't think markets will reach their last highs anytime soon. But the economic growth is definitely going to be under pressure. It is quite worrying. So there is a gloom and doom scenario that if we don't contain virus and the economic activity stalls even further, that's not going to be good news. So we just have to hope that things go back to normal on the economic front and travel resumes, and there is a vaccine that comes out, the Fed and the fiscal stimulus across the world will be sufficient to address those concerns.
Okay, with that, I'd like to thank both of you for joining us this Friday evening to try and make sense of all this insanity and volatility that we are seeing. Thanks a lot, and we appreciate you both joining us and putting things in context.
Thank you.
Right, so that's we're done with that, and now we're going to invite our next guest to talk about what it is that we're seeing. You had a disastrous Thursday. You're having a good Friday on Wall Street. We, of course, had the Friday the 13th in the first half in India. A Freaky Friday is the way to end it, the freakiest of Fridays that we've ever seen. So going into that, let's invite our next guest. He's the guy who coined the term BRICS. Let me invite Jim ONeill. He's joining us now here on ET Now. He's, of course, the former chief economist at Goldman Sachs. He's the former Commerce Secretary for the United Kingdom as well. Jim ONeill, it's always good to have you on ET Now. I'm going to begin by first asking you what you spoke about 24 to 48 hours. You believe, thank God, coronavirus didn't start in India. That would have been really bad. Can you put in context? What was that about? Our numbers are really not that bad compared to the rest of the world. Look at what's happening in the rest of the countries. And what was that comment all about?
Can I just say, actually, about the comment that people have picked up on a couple of things. First of all, for nearly 40 years of my professional life, I think my objectivity has been based on trying to both praise and criticize countries when I think the evidence suggests that is the case. And sometimes, many times, some countries don't like people saying things that are sensitive, but I think it's important for analysts to be objective. Second thing, in the specific case, even though for some reason that's what some Indian social commentators have focused on, I also made the same comment about other BRICS countries, including Brazil, and they didn't, as of yet, say much. But you know, the thing. Let's hope, forward-looking from that, something else I've often said is, let's never let a crisis go to waste. Crises happen, and how all of us respond to them, including policymakers, are a mark of how adaptive and how effective and how good we can be. And actually, despite how that story was reported, obviously so far, India does seem to be coping with this remarkable threat reasonably well compared to many parts of the world.
That's right. Compared to many other countries, we are doing much better. And, you know, that's why I wanted to ask you, what was that comment all about? You know, it's not based on facts. I know a lot of Indians believe that maybe we have good immunity. But, you know, let's leave that aside. Let's get down to the serious business and why we've got you also here, Jim ONeill. I want to lean on your expertise on the global economy, the global markets. It's great to have you on the show to talk on a day like today. We had the freakiest of Fridays today in India. Trade was halted for 45 minutes, and then we had the best ever recovery. In the United States, you had the president, POTUS, Donald Trump, saying, doesn't matter if the stock markets don't like his policies when it comes to borders. We saw Wall Street tank to a 30-year low, the worst fall since 1987. It has rebounded, and how today? Jim ONeill, what's going on in the equity markets? How are you seeing all of this?
You know, what we've seen in the past fortnight is, I think I'm right in saying, is the largest 20% decline in the US stock markets ever, or certainly in modern times. And whilst what the famous economist Paul Samuelson once said, that the stock market's predicted 8 of the past 2 recessions, it is also sadly the case that when we do end up with a recession, the stock market always falls in advance of it. And obviously there are many things to worry about that were there before, even without this coronavirus. So pending what our policymakers do in coming hours and days will determine whether this is one of the 6 of the 8 that Samuelson joked about were wrong, or one of the 2 of the 8 that were right. And it remains to be seen. I'd like to see some more decisive domestic leadership in the United States, personally. I'd like to see some more collective leadership in Europe, particularly from the fiscal authorities, but also some slightly wiser comments from the central bank than yesterday. And in particular, what seems difficult, I would love to see a repeat of what we had of 2008 and a coordinated effort at the G20 level, where even though it's very different, the sort of shock and awe that was associated with the scale of the coordinated fiscal and monetary policy response in 2008 is what we need now, together with some greater confidence that health preventive systems are being boosted around the world as well.
I think, you know, it's exactly that point. Everybody's waiting for that decisive policy action, coordinated policy actions. I don't think markets have cried out their case louder. Every stock market around the world is begging for some kind of a stimulus measure, some kind of decisive policy action, and for it to be coordinated. Where we've seen the absolute opposite of coordinated policy intervention is actually in the crude markets. Look what's happening. The price war between Russia and Saudi Arabia. It's crash-landed Brent by 30%. It's at the time of coronavirus, where there should only be one enemy, coronavirus, but that's really not the case that's taking place with these countries slugging it out for the crude markets. How are you seeing all of this vis-a-vis global growth as well?
No, we're not, and that I think that is a consequence of the slow erosion of the spirit of policy cooperation in recent years. And candidly, it's partly a consequence of the specific style of the current US leadership. But I think as the US has found out this week, and maybe a bit of a shock for the US president, that as I've often said about antibiotic resistance, something I've spent a lot of time studying, is that a lot of these antibacterial infections, which luckily this one isn't, but also viral infections, which this one obviously is a big new scary version of, they don't distinguish between borders, and they don't distinguish between whether you are communist or Democrat or black or white or Sunni or Shiite, etc. And so this is exactly why we do need international cooperation. And I think the US is going to have to find a way of subtly shifting its course and looking to have the help of others, as well as to provide help to others to make sure we can bring this thing under control. I would say, despite the tone of much of the markets and what I've said here, if you look carefully at the evidence of a number of countries where this started early, particularly in North Asia, it does seem as though they are getting it under control, and it also seems that the Chinese are allowing their economy to pick up now a bit. And if that can carry on with no new infections, and I think the other thing is now, hopefully, we get close to where the infection increases in Italy start to slow down, and I'm led to believe in the past 2 days in northern Italy there are some signs of that. That may give people a bit more hope that by deliberately closing our economies down, which the UK itself, where I'm talking from now, is close to doing, that this will just be a sharp shock to the world and our economies, and then by the second half of the year we can get back to something vaguely normal and enjoy our usual daily lives and greater prosperity for us all.
But you know, Jim ONeill, things are looking so bad at the moment. And borders, for instance, are shutting down. Malls, consumerism, all of that is shutting down. Manufacturing is shutting down. Global growth is perhaps going to be COVID's biggest fatality. Jim ONeill, you've got so many predictions right. I want to ask you one question. What you're seeing right now in 2020, could it lead to 2020 being worse than what we saw in 2008 or even 1929?
I mean, I often think I've not learnt that much from 40 years of finance, but there are a few things, and one of them is you always have to be prepared for something extraordinary and not be too dogmatic. So it is possible that we could have something worse than those years. In fact, this past week has felt just as bad as 08, to be honest. However, I do have some hope that because of the evidence of how you get out of those situations, and because of the enormous advancement of technology and health applications in particular, we can solve this with less complication than we're all worrying about now. And I wouldn't want to be overly confident, but I feel that in 4 or 5 months' time, we're probably going to look back and think we did manage to emerge from this in a much better way than people feared at the time. And there's already rumours I gather today about a Canadian company possibly having found a vaccine that could be used pretty quickly, and I think if we have our policymakers focusing on a collective way of solving this problem, then we will come out of it, as we've seen before, whether it was 2008, 1987, and so on, a number of periods I've gone through before.
So now let me play devil's advocate and ask you a different kind of a question. I've got you on where you think 2020 is vis-a-vis 2008 and 1929. But Jim ONeill, it's very easy to also talk ourselves into a recession. Are we already in a recession? Or is there hope? Look what's happening in China, for example. Look at the countries where we saw the outbreak early. You know, it's peaking out. In China, the factory is already coming back to life. So do you think the latter half of 2020 could perhaps be dedicated to recovery, or am I being optimistic?
We definitely have all the warnings that is the case. And what does make it more complicated here, in many big economies, we are deliberately shutting down our consumers in order to control the spread of the infection, and we don't really have any choice. You've seen that in a number of European countries. We're seeing evidence of it here in the UK and in the States, and there's nothing else we can do. But I think so long as our policymakers give us all confidence that it will be for a very limited period and there won't be great personal suffering, I think the markets, as they've often done in the past, will show an ability to look forward and start focusing on the second half of the year in a recovery once they know for sure that if we haven't reached the peak infection rate or the peak rate of spreading, we will do soon, and that we will all know it's just a very short shock.
If I could come to India specifically now, Jim ONeill, I want to get back to crude. What we're seeing in the crude market is, of course, a big positive for India. It's fantastic news for us. But globally, low crude prices don't go hand in hand with a high growth rate. It's very positive for India. But this range that you're currently seeing, do you think it's the new normal?
So I think you just raised a very important point that I haven't touched on yet, in that whilst the drop in oil prices is obviously related to the weakening of demand and the weakening of the world economy, notably led by China, it is obviously for many countries, India in particular, really good for the real incomes and for consumers. And so this is part of the self-cleaning mechanism of international economics in a strange way, and it sows the seeds for helping economies through their consumers recover. And I think right this moment, India is not alone in being a place where investors don't want to explore internationally, but again, as we've discussed before, because the Indian economy is so strongly driven on domestic factors, it inherently has some built-in attractiveness that makes India a bit more resilient than some of the North Asian economies that are so heavily dependent on global supply chains and international trade. And so I don't think India will particularly fall out of favor because of this factor at all, no.
You're making my Friday. You're making all our viewers Fridays. You know, we walked into this show about where there's going to be all gloom and doom, but there's Jim ONeill there for you, ladies and gentlemen, saying India's not going to fall out of favor. So, Jim ONeill, my final question to you, expand that for us. You know, everyone seems to be dumping right now and playing it safe. Why are you saying what you're saying?
Well, I think that's going on everywhere in the world the past few days, to be honest. It's not unique to India, but as I say, it seems to me India has some inherent attractions that some other places don't. And at the end of the day, and going back, of course, to the famous BRIC acronym and why India stands proudly in the middle of it, because of India's youthful demographics, there is enormous scope for India to grow more strongly than virtually anywhere else in the rest of the G20 economies for the next 2 decades. So if a lot of panicky investors are panicking too much, then it, as we often see in times of crisis, it gives an opportunity for the more objective and more savvy and perhaps risk-taking investors to use that as an opportunity to invest when others aren't.
And on that positive note, I'm going to wrap up this Friday's discussion with Jim ONeill. Always a pleasure talking to you. Thank you so much for joining us here on ET
Thanks
Now.
for
It was
having me
the
on.
freakiest of Fridays that we have for our markets. And who better than to have Jim ONeill to try and help us navigate through the insanity that we're seeing, not just in our own equity markets, but around the world. Huge crashes followed by massive recoveries. That seems to be the theme that we're seeing this evening. But you just heard Jim ONeill saying that, when you have times like this and big sell-offs, it brings opportunities. So let's get you some of the biggest of market voices in India talking about some of the opportunities that exist, what they made of Freaky Friday, and what all of you should be considering with your portfolios.
Usually markets find a reason to cling on to justify a certain move, whether up or down. And the virus has come at the opportune time. But even prior to that, we have spoken many times that in India, India was in a stealth bear market for 2 years. Just a handful of stocks was keeping things up. And those things can't last forever. Those things end, and they end badly. And that is exactly what has happened.
So, Shankar, if you're feeling like a kid in the candy store, what is the kid looking at buying?
No, so we are pretty systematic. So we have a process. We are seeing things that we like 5 days back are down. Another 10% today, maybe 15%. So and again, I repeat this. There's no way to find a bottom. But on the other hand, I don't think you should be really looking at all points in time to be a buyer. I don't subscribe. We have never subscribed to that basic overall motherhood statement that we hear. Because I remember 2009 March when the markets made a bottom. Despite having been convinced the market bottom was there, I could not bring myself to change my mindset, and I missed the first part of the rally, which was a very strong one with stocks rallied like 40-50% up to June. So I got in June. But 10 years later, did it matter whether I got it in March or did I get it in June? No, it did not. The fact of the matter is I was better off buying in June than I was in March, because I was buying with a big, strong momentum behind.
I think there are two kinds of investors, and people confuse even if you are leveraged as an investor. So if you are a leveraged person, your level of leverage will decide what you need to do and what sort of risk appetite you have. So I would consider them separately. And a lot of the times when we are talking about being concerned, it is the leveraged person and not really someone who's just an investor. If you're an investor, you just ride out this atmosphere. These are extraordinary times, and these are stories that you will tell, but it doesn't affect your portfolio in the long term. Things will go back to wherever they are, maybe 6 months, 1 year, so you don't have to worry. And if you're an investor with cash, that's the real category that needs to be more alert and has to think as to what to do.
I don't think we have seen a crisis of this kind before. A real-life medical crisis spilling into financial markets. Typically, it's always financial market crisis which spills into real life. It's a real life spilling into financial markets because of the fact that people are reacting in a certain fashion, which is leading to economic activity stopping and travel stopping or quarantines happening, etc. So that's the first. We don't have an experience. I think what market is doing at this point in time is just jacking up the risk premium in the absence of the fact that it doesn't know how this thing ends. So therefore, you just increase the risk premium and everything falls. So all markets falling. What market is telling you is that I don't know how this thing ends. Let me price in a very high amount of risk, and let me therefore sell riskier assets more than the less risky assets, and then we'll see what happens.